Good evening. Welcome to another episode of the Weekly Market Web. Today, of course, it's May the 4th, 2025, and the first weekend for the month of May. And in this episode, we're going to talk a little bit about the dramatic change of events leading to the Wall Street following the weekend, practically erasing all the losses we've seen in April. So before we go into the content, I'd like to remind you this presentation not an option to buy or any security IronFX is for any margin products. Trading of any kind of margin, financial products to carry risk, so to understand your own risk profile before you try to trade them. Okay, and the opinion expressed in the presentation is strictly mine alone, as compared with the quotes and the point. And whatever opinion I'm going to share with you are typically mine, and these are not financial advice. Content of this presentation, of course, has not been vetted by any regulatory body. Okay? Now, first off, the market. Remember, last weekend we had Canadian going into elections, and true enough, the incumbent, which is Mark Carney, won the election by a wide margin. So that the previous prospect of winning the premiership was actually swept aside. He not only did not win the premiership, he actually lost his vote in contest. So this is a reflection of the impact of anti-Trump movement in Canada, and it will have implications because on Monday, Mark Carney will be meeting up with Trump to talk tariffs. I'm sure Canada is going to be putting up a very strong case for why tariff is not the best way forward. And at midweek, we also saw how President Trump walked back on some of his tariff policies in regard to auto parts. We knew that for 25% tariff on auto parts, and particularly against Canada and Mexico. And this is on Tuesday. And what he did was propose to actually provide credit to 15% of the value of vehicles domestically imported from both Canada and Mexico. Okay. However, before the weekend, we saw that why, and this regarding the function of the tariff for both auto parts imported in Canada and Mexico. So this is simple flip-flop policy, giving that its policy goes along, they're planning the system. So this is where the 25 tariff applies for other countries, but for Canada and Mexico, is actually waived now. Okay, so reflection of the pushback from domestic lawmakers, and this is having looking the 180-day return in its policy. And this will in terms of equity price to recover very strongly Friday, actually true for the Nasdaq. So Nasdaq actually the blunt of the sell-off, and it's only logical that any kind of recovery will also be magnified in the Nasdaq. Concept we have a next level 5. That's also true for follow-through Friday. So this is actually for further gain as the weeks ahead. So we're going to begin May on a formal note, whether this will be the case all the way through. In that oil has been sold off, and this because over the weekend on Friday, OPEC Plus has gained peak production, and I think this is to actually punish those members who have the healing quota, particularly Iran and will have taken when the market reopens tomorrow morning in Asia. Okay. Oil prices are below $60 per barrel, and it may likely to stay below $60 per barrel for quite some time. And the other markets also saw a big pullback in price of gold. Gold on Thursday saw a almost 3% pullback, and actually also confirming what we are doing for more than a week now. Then gold is likely to go into a period of consolidation, perhaps to a backward consolidation with a little bit bias to the downside, also taking profit. Okay, so this is where we stand. Now, if you post them in the Q&A so that we can actually get. Oh, okay. I hear that you guys are not able to hear me very clear. Maybe I can switch my. Let me switch my audio. Is this better now? Can you guys hear me better? I've unplugged myself from. Okay, very good. So it's just my audio issue. I was trying to play with a new headphone. Sorry about this. Okay, good. Now let's continue. The numbers that came out this week is actually this past week has actually been a few things. One is the labor numbers as well as the GDP number for Q1. Let's talk about the ADP, which is a private employment change. We can see that that has taken a hit. The revision was actually from 155,000 jobs created to 147. And for the month of April, market was expecting 108,000 jobs being created. It came in 40% less at 62,000. So this is a reflection of the private employment situation, whereby we can see there's a marked decrease in number of private jobs being created. Now, when we compare this latest number from April all the way for the whole of 2024, we can see that it's the lowest number of jobs being created in the private sector. So this will have an impact on the non-farm payroll, which was released on Friday. Now, the shocker here is actually the Q1 GDP for US. We can see the annualized GDP numbers for the United States has actually gone negative. Now, in Q4 2024, we have GDP at 2.4%, and Q1 came in at negative 0.3. So this is actually a lot worse than the market expected. When the market was expecting a drawdown in the GDP number for Q1 at 0.4, but it came in at negative 0.3. So this is actually quite a bit of a shocker. So logically, we would think that based on this very poor number, equity prices should actually be coming off. But lo and behold, we actually have equity prices rallying towards a weak highs. And we're going into the month of May with very high expectation of follow-through buying based on the momentum that we have seen this past week. Okay, and we have also inflation numbers. Here we have the core personal consumption expenditure. Of course, this is the Federal Reserve favorite inflation gauge. We can see that they are all both come down on a month-on-month basis as well as on a year-over-year basis. So what we are seeing here is not lower inflation. What we are seeing here is a potential situation called stagflation. So prices has been coming down, and it has come down very, very sharply. And I suppose this is a consumer reaction to the tariff situation that we have seen since throughout the whole of April. So this markdown in prices is not a situation in which inflation is coming off. It is a situation in which consumers has actually tightened their belt to the point whereby there is a drastic drop in prices. So we can see this is a risk that we have to contend with in the months ahead. The risk of stagflation is even worse than the risk of recession. Now, remember, recession is actually part of the business cycle, which is typically able to be dealt with very comfortably by central banks. Okay, but if it's a stagflation, it becomes a little bit more sticky because on the one hand, you only have one lever as far as the central bankers are concerned. They only have either to hike interest rates to actually tame inflation or to cut interest rates to actually promote growth. But if we have a situation in which GDP is already in negative territory, so there will be a case for the Federal Reserve to cut interest rates. By the way, going into this week, we're going to be seeing the FOMC meeting, which is the Federal Open Market Committee deciding on interest rates. Market expectation is that the Federal Reserve is going to stand pat. You need to say that they may not do anything on interest rates while they observe the data coming in the next few quarters or months to actually decide whether inflation is actually an issue. But if they cut interest rate too early, it
run the risk of actually inflating inflation all over again. So again, it is a very difficult situation, not the best of time right now to cut interest rate because of risk of reflaying the inflation situation. On the other hand, we have a weak economic growth, and the impact of the tariff policy is definitely having a negative connotation here. Here we have the Manufacturing Purchasing Managers Index for the month of April, and this is referring to the ISM version of the PMIs. Okay, again, the PMI numbers is still below 50, although it is slightly better than the market expectation. So 48.7 is lower than 49, which is the last number for March. Okay, so again, we can see that the manufacturing sector is definitely still staggering from less commitment in the private sector, okay, for manufacturing. This coming week, we're going to be also be seeing the services PMI numbers, and we will be looking towards see whether the services sector has also been negatively impacted by all this negativity surrounding the markets. Of course, this will be the major numbers that we are expected for the labor markets for the United States. We can see that on the whole, the labor situation in US remains very stable. Previously, for the month of March, we have 228,000 jobs being reported. That has been revised downwards to 185,000, and the consensus is for 130,000 jobs creation. But we have a better than expected at 177,000. So as far as this number is concerned, we don't see any worse of situation in terms of a number of jobs being created, and the unemployment rates remain stable at 4.2%. However, I want to act that this number has a problem, okay? Because in the year 2021 to 2024, the massive increase in migrants into the United States has not been captured by the Bureau of Labor Statistics and only been inputted, they only take this number into consideration at the beginning of 2025. So we are beginning to see those numbers that come in as a result of illegal immigrants into the United States beginning to show up in data. Okay, here we can see that the labor force has jumped by more than 500,000 in 1 month time, from March to April. And a lot of this has got to do with the numbers that has been coming in on stream for the migrants that has been pouring in through the southern borders before Donald Trump comes into his second term. Okay, so here we have the numbers showing that as of January every year, the BLS, which is the Bureau of Labor Statistics, will adjust this household data once a year. And now we are beginning to see that happening. So this number that we see is somewhat of a lagging data. Meaning you say that those data that we have not been able to capture for the last 4 years is now beginning to show up in those numbers in year 2025. So again, we have to watch this number as we go along. Now, don't forget that the unemployment rate of 4.2% represents total unemployment in absolute term of 7.16 million Americans are still looking for jobs. So that is a big number by any standards. So whether or not that will impact going forward is definitely something we have to watch. If the labor numbers, this unemployment rate start to rise above 4.2%, and then on the back of a negative Q1 GDP, that will be the evidence that we are looking for in terms of a stagflation. So if the unemployment situation worsen in the months ahead, and we still have very weak economic growth, that will be the evidence that the United States is slipping into a stagflation. Like I mentioned before, stagflation is definitely a more sticky problem to solve than a regular recession. Okay, so the average hourly earnings you can see that both on a month-on-month and a year-over-year numbers, they have become rather stagnant. Okay, there's hardly been any growth in the hourly earnings, meaning to say that wages are not catching up. Okay, and that will be a problem going forward because we are beginning to see weak economic activity. I mean to say that consumption level may actually go down as a result of hardly any growth in the wage front. Okay, so the average hourly earnings month over month has decreased by 0.1% from 0.3 to 0.2. And on a year-over-year number, it remains stagnant at 3.8%. So this is definitely not the numbers that will make the Federal Reserve happy. We need to say that from this number, we can see that in the months ahead, consumption will likely be on the negative side rather than on the positive side. Now, in terms of market reaction, you can see that the Dow Jones has actually recovered beyond the initial bounce from the low in September, in April the 7th. Remember, April the 7th was only the week where Donald Trump actually rolled out Liberation Day, reciprocal tariff, and we can see that that 90-day pause as a result of that low has actually saw the market have a sharp reaction to the upside. And this week itself, we can see that the market continue to recover, and now it is at a peak higher than the initial reaction. The Dow Jones closed at 41,317. It is the least reactive of the major equity index in the States. The one that has the highest reaction to the upside is actually the Nasdaq. So as far as international managers are concerned, they have not really come back into US equity in a big way, okay? So we will want to continue to monitor that. The S&P 500, on the other hand, which is a more retail-oriented index, shows a sharp increase in retail participation in the latest rally on Wall Street. So we can see S&P 500 has bounced way, way above the initial bounce on the low of 4,835. So we can see as the month concerned, for the last 30 days, the S&P 500 has gone back into positive territory at 12%, although on the year-over-year basis, it's still down 3.3%. Now remember, the S&P 500 at one stage was negative 21%. So for it to climb back to only down 3.3% is actually a major, major rebound, okay? The biggest rebound here seems to be in the Nasdaq 100. Here you can see on a close-to-close basis, the Nasdaq is already trading at close, okay, close to the high that we saw in February 19. The high then was 22,222. This week closing was 20,102. So this is on a close-to-close basis, okay? So we can see that Nasdaq 100 has the best reaction so far, okay? From negative 20% now it's only down 7.5%. So there has been a major, major reversal. Let me see what question you may have for me. Tanvi is asking, where have the international money managers flow their money into instead? Another instrument or another country? If you look at the diversion in terms of equity index, you can see that Europe right now is actually having the best reaction so far. We look at the DAX, which is the German index, as well as FTSE. We can see that the index in Europe is trading at much higher levels, and perhaps in the coming week, we can actually see new highs being created in Europe rather than on Wall Street. So that could be where the money is heading right now, because we can see that there is a sea change in how Germany is going to tackle their recession. Okay, we see that Germany has actually opened up their wallet and actually in terms to go into deficit spending, okay? And this is something unusual because since World War II, we know Germany has always been very conservative. They have always kept their deficit relative to the GDP at a certain percentage, which is very, very low. But for the first time in 80 years, we are beginning to see that Germany is actually abandoning those very conservative approach to ramping up their economy. Now, instead, they are definitely gearing up to borrow, okay? And all this has created a lot of confidence that the European continent is actually going to outdo the American continent in the months and years ahead. However, this remains to be seen because going forward, I do see the geopolitical situation in Europe turning from bad to worse. Okay, that could actually be a negative in the months ahead. Perhaps we don't have to wait that long. I think in this month of May, we may see a dramatic reaction as far as the geopolitics is concerned in Europe. Okay, because as we all know, this past week we have the US and Ukraine signing a mineral deals, and in the days that follows, we can see the US has resumed sending arms to Ukraine. So does that imply that US is back into supporting Ukraine for the war? And if that's the case, it would definitely upset the earlier narrative that peace is around the horizon. Okay, right now it seems that there is no more talk of peace because US has actually disengaged from being a mediator for between Russia and Ukraine to strike a peace deal. So that could actually be a negative in the months ahead. Okay, like I say, we may not have to wait very, very long because I think May is going to be very crucial, especially in the third week of May onwards. Okay. And as far as gold is concerned, we can see gold has a bit of a pullback. The high traded was into the last week of April. We have $3,500 in the spot market, and we can see the prices has come off $260 since. And this is part of a consolidation, which I suspect is going to last for at least this month of May. Okay, whether we're going to get a deeper pullback remains to be seen. So far, it is a very typical correction in a three-way formation. So later on, when we go to the chart, we will talk a little bit about gold. But for now, we can see that gold prices has stopped going up for 2 weeks in a row, and that is actually a pause within a very dramatic bull market in gold prices. Crude oil has actually been trading below $60, and this may actually be worse in the coming days. Tomorrow morning, when the oil market open in Asia, we may see a dramatic drop in the oil prices. But just be aware that at $50 odd dollars is already the lowest we have seen in oil prices. This is partly a result of the OPEC plus, which is also inclusive of Russia. And I think the driver for the increase in production was totally unexpected. I think Saudi Arabia is taking the lead to increase production, largely to actually punish members who have been producing more beyond the quota. And that I think Saudi is basically pointing the finger at Kazakhstan. However, Kazakhstan's oil production is not in the hands of government, it's in the hands of private oil producers. So basically, I think at the end of the day, whether that is also a narrative to actually go in sync with President Trump's desire to lower the price of oil. But for now, we can see that this latest development, which is only announced on Saturday, is likely to cause oil prices to unravel when the market reopens tomorrow morning. Okay, so do watch out for a reaction. I think it will trade possibly below $56.39 so far, which is the low at the beginning of the month of May. Okay, so this is actually where we are right now, looking for lower oil prices, but oil prices is as low as it's been because anything below $65 is actually going to cost a lot of oil producer to actually stop production because it is already below the cost of production. Okay, especially those shale oil from US producers. They need oil prices to stay above $65 to make it profitable. Anything below $60, I think they will have no desire to produce. So over the longer period of time, we can see the market may actually stabilize at some point in time. So be very, very aware as the price of oil continuing to slip. It may not be that far before it actually stabilizes. So look out for the reversal if it does come. Okay. Now, the dollar continued to rebound after hitting a low on the dollar index below 100, and we're beginning to see a rebound. This is very much a reverse relationship with the price of gold. Gold has a three-wave pullback, the dollar index having a three-wave bounce. So they are very much in sync. So long as the dollar continue to stabilize and rebound, there is possibility of lower gold prices as we go forward. Okay. So now we are into the second 20th week of the 52 weeks for the year 2025. Let me go into the chart to show you what I mean. Do let me know if you can see my chart here. Tanvi is asking another question. Is that has the positive earning of tech stock caused the National 100 to bounce? I think it has a lot to do because right now we're in the middle of earning season for Q1, and we are beginning to see some of the tech stocks have actually did better than their analyst expectation. So we are beginning to see buyers coming back or investors coming back into the tech stocks. So this could be where we are right now. So let me refer you to the chart. Here we have the Dow Jones. Now Dow Jones is basically still very much in the bullish phase. And last month, for the month of April, the fact that the Dow can actually recover from 36,500 to where it was at 41,000, there is a marked improvement in the recovery. And so far in the first 2 days of trading for the month of May, we are beginning to see that prices has not slipped. So this could actually create a condition for further gains in the weeks ahead. Now, let me show you the weekly time frame. Because you can see the weekly time frame also refers to how the market closes near the higher end of the week's trading range, okay, at 41,316. So this is actually putting the stage for higher gains ahead. And if we refer to the daily time frame, the nearest target where this recovery may actually hit some kind of resistance is anywhere between 42,268 to 43,200. So anywhere between these two bracket here of 42,300 to 43,200, I think there is the possibility of the re-emergence of selling interest, because this is part of a three-wave bounce. And the nearest target here, we have a swing high at 42,859. So do watch out for this number. I think the market, I think based on momentum that we've seen on Friday, is likely to continue forward towards the 42,300 level, at least for the initial reaction. Okay. Then when we look into the S&P 500, which is the market has actually have a much larger degree rebound, you can see that this closing on a monthly basis this is very much a reversal pattern, okay, setting the stage for a break of the all-time high at 6,149.87 in the cash index. So going forward, there is a very high possibility the month of May may actually see new high being created in a lot of major equity index, in particularly the S&P 500. When we look into the weekly time frame, I have to remove this to the side. Weekly time frame, you can see the weekly time frame also have a closing very near the upper end of the trading range for the week. And this is in danger of taking out the immediate point of invalidation at 5,790. Okay, so I think in the next 24 hours or so, I think there's a real risk that the market will take out this 5,790 and we actually revert back to a very positive bias on the weekly time frame. On the daily, you can see that this level is the same, 5,791. And that is the nearest where we are right now, because the market closed at 5,685.3. Going forward, I think there's a real risk that the market will be eliminating the negative bias and actually reverting to a very positive directional bias for the S&P 500. When we look into the Nasdaq has a very, very big reaction. You can see that among all the major equity index on a month-over-month basis, we can see the Nasdaq 100 now has a very classic reversal pattern with a low of 16,329. And this is setting the stage for higher gains in the days and weeks ahead. Okay, on a monthly basis, this is one of the most positive reaction. Okay, then on the weekly basis, again, we are also seeing that the trading range where the market close for the week is actually near the upper end of the week's high. Okay, the market closed at 20,100 and the point of invalidation for the weekly time frame is 20,350 thereabout. And I think the first index that will break this high will be this market here, the Nasdaq 100. Okay, daily time frame is the same thing. 20,350 is the number to break. Since the market take out this resistance line, you can see that this three-wave bounce may see prices going towards the 20,500 to 21,200. So this will be the immediate pocket of prices in which it may meet some kind of initial resistance. But by and large, it runs the risk of reverting the negative sentiment in these markets to a positive one in the days ahead. Earlier on, I did show you, or rather in reaction to Tanvi's question about whether the international money managers, the capital flow has moved, where have they moved to? I think there's a very good chance they have moved over to Europe. Here, again, we can see that this is the FTSE 100. We can see how the month closes for the month of April. Very, very strong reversal from a low of 7,531. So the way forward, I think there will be the most likelihood is that the market will take up into a new high beyond 8,909 so far, which is the all-time high for the FTSE 100. So the market is actually gunning for higher prices ahead. Whether this positivity is warranted, that is beside the point. The thing is that the momentum over the last 3 weeks has been very, very strong for the FTSE 100 since the 90-day pause. And of course, the latest sentiment is that there is a possible likelihood of US and China getting into a negotiation, because the signal coming out from China seems to be wanting to talk, and that has created the momentum for stock prices to actually rally. So it's not so much of where the fund is moving. I think the fact is that there's a lot of hope being put into the likelihood of US and China finally talking to one another as far as this trade war is concerned. So this has been the optimism in the last few days of trading for the week. So this optimism has caused equity prices around the world to actually perked up. So going into the new week, let's see whether will anything come out of this expectation. In the daily time frame, you can see the market also closed on the Friday's high. Very, very, very strong momentum. So this actually put it in very good state for a follow-through buying beyond 8,745 in the coming 24 hours. So this is FTSE. Let's talk about the German index. This is German DAX. German DAX is also very, very strong. You can see this is a classical reversal on a monthly basis. The low is 18,813. And among the European index, the first one that will actually create a new high is most likely going to be the German index. Okay, like I said, Germany for the first time in 80 years is beginning to go into deficit spending. And that has boost a lot of expectation into where there will be economic growth coming up from Germany. Okay, but again, this one had to be tempered against a background of the geopolitical situation as far as Ukraine is concerned. The fact that Trump has actually now have a mineral deal with Ukraine, and the fact that he's actually stepping back from being a mediator between Russia and Ukraine may actually put a negative spin because it does appear that now the US is back into supporting Ukraine. And this means that there will be no peace in the current situation as far as Ukraine is concerned. So there is the risk that the situation may actually worsen in the months ahead. Okay. And that could actually undo all the gains that we see in Europe. Because if the conflict between Russia and Ukraine actually spill beyond Ukraine, that will mean there will be a direct conflict between Russia and NATO, and this will cause capital to flee Europe. And if it does happen, the first thing they will do is to sell European equity markets, and the capital flow may actually flow westward towards United States. So if there's going to be an escalation in the conflict in Ukraine or in Europe, the beneficiary will be United States. And that means that the capital flow will go into equity markets, in particularly the Wall Street. So that would be the dynamics to look out for, okay? So when you look into the weekly, we can see confirmation that the last 4 weeks has been very, very strong momentum, practically erasing all the negativity that we have seen for the whole of April. So going forward, 23,500 appears to be not defensible. I think the market will punch through within the next few days. Okay, this coming week is going to be crucial. If it does, then the corrective pullback that we see for 23,500 all the way to 18,800 will be practically erased. Okay. This is the daily time frame. You can see the momentum has been very, very strong. Initial restriction is again at an all-time high at 23,485. Now, as far as Asia is concerned, let's take a look at the Nikkei 225, whether we see similar momentum. Here we can see that April has also been a very, very strong reaction. Now, if you look back into August of last year, there was a similar move, okay, all the way down to 30,400 before a very sharp recovery to almost 40,000. So far, the market has been kept at 40,000. The Nikkei 225 has not been able to close above that magical number despite a few months of trying. Okay, so now we have another rebound from the low of 30,357. Okay, and last month, for the month of April, this market created a major reversal pattern on the monthly time frame, which is very, very powerful. So we can see that the first 2 days of trading for the month of May end up with Nikkei closing at the high. So this is again creating the condition for higher prices, but we will have to take the lead from Europe. So watch out for Europe taking up new highs before we can see follow-through buying in either Asia or on Wall Street. Okay. Similarly, we see that the overall pattern for the Nikkei 225, 4 weeks of rally from the low of 30,357. This is a very, very strong momentum, but it is not as strong as what we saw in Europe. So again, I think Europe will be taking the lead in the days and weeks ahead. If they manage to climb into new all-time high, that will provide the impetus for follow-through buying in equity markets around the world. Daily time frame is also very similar. The first level to take to watch out for will be 38,231 in the Nikkei. As far as Hong Kong is concerned, let's take a look at Hong Kong. Okay? Hong Kong does not have a very strong momentum. It is still locked within the three-wave bounce from the low of 14,600. The high so far is at 24,900. So again, unless this level is taken out, it is going to be very difficult for Hong Kong market to climb significantly. But again, if the sentiment has changed, especially if the US and China has actually initiated talking to each other, they may actually provide the positive bias that the market is waiting for. So far, among the equity index, Hong Kong seems to be still locked into a corrective rebound, not so much as a break of all-time high. Okay, so this can be also be seen in the weekly time frame. The bounce from 19,000 has been pretty strong. Okay, although we don't have 4 continuous week of gain, but it is relatively strong because the low created at 19,047 created a condition for a bounce. You can see this is a major reversal pattern on the weekly time frame, and true enough, the momentum has carried forward the Hang Seng. Whether it can take up 25,000 remains to be seen, but I think that will be the level to beat. Okay, if this market can take up 25,000, it create the condition for further gains in the perhaps in the weeks ahead. On the daily time frame, it is not as strong, although the market has closed this initial gap created by this 22,440 all the way down to this high here that we saw in the following week at 21,000. So again, we can see that this gap has been fully covered, but now the market closed above this level, setting the stage for perhaps a try at 23,800. Let me see if we have any further question before we move on to the other products here. Okay, no new question. We'll move on to currencies. Here we can see the dollar index has have a bit of a recovery on the weekly time frame, but not a very, very strong recovery. It's very tentative. There is still risk that the dollar may continue to slip. We have 2 weeks of gain, okay, but very, very incremental gains. So there is no reason to suspect that the dollar has hit a bottom just yet. But going into the middle of May, there is a possibility of a major reaction. Here, I say there's a possibility of an explosive reversal, likely in the week of May 19, which is the third week of May. If that's the case, that could be something that may be implying something dramatic on as far as the geopolitics is concerned. Now, not only there is another new development since last week, right? We saw that the situation in Ukraine has actually not improved. Now we have another hotspot that threatens to actually blow up, which is the situation between India and Pakistan. Now, both are nuclear power, and the situation in Kashmir, where India has been very, very aggressive, there is the risk that there is going to be another hotspot. Okay, so we will have to keep our eyes peeled, as not only for the situation in Europe, we also have to keep our eyes peeled for the southern continents here. Okay, so we want to see how the geopolitics play out, because if that's the case, then there's a good chance there will be a move into a safe haven currency, which is usually designated for the dollar. Okay, so watch out for that possible move. So as far as the pattern is concerned, we can see that I shouldn't be showing you this. I should be showing you the 4 hours. In the 4 hours time frame, we can see that there is the possibility of a three-way bounce. Okay, and if this is the bounce that I'm referring to, there is a possibility the upside could be very limited. Okay, here if it's a three-wave bounce, equality is about 100.72 to 101.21. So this is a three-wave move. Equality is somewhere between these two bracket of prices, and that suggests that once this three-wave bounce is over, the market may resume to the downside. Now, this is the 4 hours time frame, referring to the fact that the dominant trend still favors further losses in the value of the dollar. Okay, the near-term outlook again is very similar to what I've shown you on the 4 hours. Okay, 172 to 101.21. Okay, this will be the thing to look out for. In the euro versus the dollar, we can see that on the monthly time frame, this rebound from 95 cents to the dollar has hit a high last month at 1.1572. Okay, so this may continue to actually extend higher. Target is between 119 to 123 in the euro versus the dollar. So this will be a three-way bounce. Technically, this is a rebound, suggesting that once this rebound is done with, the market will resume its downslide. Weekly time frame suggesting that we may be seeing a reversal pattern here at 115.73. So this is not as classic, but it is suggesting weakness ahead, at least in the near term. In the daily time frame, this pullback is still very corrective in nature. Support could be anywhere between 112. Okay. In the lower time frame, I do expect prices to hit about 111.55 to 111.60. So this will be a three-wave pullback, suggesting that if the market can hold around this area between 111.55 to 111.60, there is the possibility that the buyers may re-emerge to take the market again to the upside. Sterling is the same thing. When you look at sterling, when you look at a monthly time frame, this is a very corrective rebound from the low of 103.50. So you can see if this is a three-wave, the target is anywhere between 148 to 155. This is based on the monthly time frame. And if that is the case, we know that the market have already break structure above 143.75, which is the previous high, which was last seen in 2017. So this will be crucial. Whether the market can actually punch beyond the 143.75 remains to be seen. But if it can, just to understand that further upside is going to be quite limited to 148 to 155. Weekly time frame. Market has been consolidation. You can see that this week we have a marginal high at 134.44 before it closes week. So this is again one of the classic reversal pattern on the weekly time frame. It does not mean anything just yet, okay? But if the market do close below the low that we saw the week before, which is 132.30, then it may actually trigger a more pronounced profit taking. Higher time frame, very similar in the lower time frame of in the 4 hours. I think there's a possibility of market pulling back all the way to 130 to 131. Okay, so if further downside is expected, unless the 130.30 is taken out, I think I would still maintain a somewhat positive outlook in the sterling, at least in the near term. The other currency pair that we will also be watching, okay, is the dollar relationship with the yen. Now, the dollar has actually peaked near 162 back in 2024, okay? That was in July last year. And so far, the price action has been suggesting that lower prices ahead, but it's going to be quite limited. Somewhere between 131.5 to 136.80 is going to be where the bottom may be located. For a time being, the market has respected the low at 139.60 so far. Okay, the low that we saw in April is 139.88. So it did not quite take out the low that we saw in last September. On the weekly time frame, this three-wave pullback does looks like it's not complete. There's still the risk of market declining below the 139.58 all the way into this bracket of prices between 131.20 to 136.5. So look out for further losses in the dollar versus the yen into this bracket of prices, which may actually be very conducive to reposition buying on the dollar. For the last couple of weeks, we can see that the dollar has bounced from the low of 139.88, and this is so far three-wave, meaning to say this is corrective. Upside potential is actually not very, very great. So if this is the case, the market may actually target somewhere around the 146 top side before it meets some kind of resistance. So further gains in the dollar versus the yen is not that pronounced as yet. Let's take a look at the Aussie versus the dollar. Now, Aussie seems to be finding a bottom at just under 59 cents to the dollar. So we can see that that is actually a condition for further gains in the Aussie versus the dollar. So going ahead, I think my immediate bias is a recovery in the Aussie. This can be seen in the weekly time frame. For the last 4 weeks or so, we can see the market bounce very, very strongly from a low of 59 cents to the dollar, and market last close at 64 cents. So we can see that buyers are coming back in the Australasian currencies, in particularly Aussie and the Kiwi. The high so far this past week was on Friday, when the Aussie traded to a high of 0.6469. Okay, this is the highest we have seen since March. So this is actually a very positive sign. Whether the market can actually sustain remains to be seen. However, if the market can come back 50% from the low of 0.5914 to 0.6469, the 50% mark will be at 0.6192. So if the market does pull back to 62 cents to the dollar, that could provide the immediate support for the re-emergence of buying interest. Do watch out for this. What about the Kiwi? Like I say, both the Aussie and Kiwi seems to have benefited from the current weakness in the dollar. We can see that last month the low in the Kiwi versus the dollar was at 54 cents. Okay, and this is as low as we can see since going back to 2019. So we have a double bottom of sort here. So technically speaking, that is supportive of the technical outlook in the rebound for the Kiwi dollars. On the weekly time frame, you can see that except for this past week, over the last 4 weeks itself, the market has been going higher in terms of the Kiwi, regaining back some strength. So this is back, maybe part of that what I call short covering. Not so much as new buyers coming in, but for people who are taking profit on their short position in the long decline in the Kiwi dollars. On a daily basis, you can see that the rebound has been pretty strong. This past week has been a little bit of an anticlimax because there was no follow-through buying this entire week. So going forward, this could be seen as a technical pullback, giving rise to the possibility of engaging the market on the long side if the market do recover. So if the market do pull back, one area to look out for will be the 58 cents level in the Kiwi versus the dollar. This will be a good area to consider looking out for reversal signals and the re-emergence of buying interest. Any other question that you want to post me? Sing dollars. Okay, let's take a look at Sing dollars. Nobody have asked me about Sing dollars before. Okay, anyway, this is the outlook for Sing dollars. The dollar versus the Sing dollars has gone into a sideways pattern. Now, the dollar has been coming off against the Sing dollars, meaning to say that Sing dollars have been on a relative basis quite strong. Currently, the euro and the US dollar versus the Sing is already below 130. Okay, the closing price on Friday was 129.80, and this has come off from the average price of 133. So we can see that the euro has the US dollars has also declined relative to the US dollar to the Sing dollars. Now, with the weekend result in the GE for 2025, the incumbent party has managed to retain its majority, so that could actually have a positive spin for the Sing dollars going forward. Tomorrow we might be able to see further gains in the Sing dollars. So this is the weekly time frame. The overall bias in the dollar versus the Sing is still negative, meaning to say that the dollar continue to slide, and we may see prices going below 128. So the low so far last year was 127.88. So is there a risk whereby the dollar continue to slip below the 127.88 that we saw in 2024? That is a real possibility considering the outcome of the general election that we have over the weekend. Okay, in the daily time frame, you can see further slipped. There is no buying interest. Basically, the market is still very weak for the dollar. So this is also very much in sync with the outlook for further weakness in the dollar versus the Sing dollars. Okay. Anything else you want me to talk about? This is a bit unusual because so far nobody asked me about the Sing dollars. All right. If there's no further, then I will go into gold. Now, gold has obviously gone into a profit taking. Okay, the explosive gain in the price of gold has been very dramatic. The high is that $3,500 per ounce, and that was created last month. Okay, so far we have seen for 2 weeks in a row we have seen gold prices continue to pull back, and this is definitely a profit taking. Okay, so the high at 3,500 is the temporary high so far. There is that possibility. Now remember, going into the last week of April, I did mention that there's a possibility that the market may have a temporary high. And true enough, it was actually at a very round number of $3,500 per ounce. And since then, we can see that the pullback in gold remains very much in place. There's a bit of profit taking. It doesn't mean that sellers are in the market. It means that people who have gone long gold is basically they are basically taking profit. So there is no evidence that sellers are coming into the market. It's basically profit taking. So do not try to sell the gold because the overall trend remains very, very bullish for gold. Okay, we may see further weakness in the gold prices, but again, this weakness could last anything into the third week of May or even into the end of June. So for the next 2 months at least, any kind of pullback is actually a buying opportunity. If the price of gold can actually go lower, it will be a bonus, honestly speaking. Okay, so this is a daily time frame. We don't see aggressive selling. In fact, there's a risk that there in the in the coming week we may see a bounce in the gold prices. The low prices traded in the spot prices is $3,202. So far, we have a bit of a bounce with a risk that we may see a three-way bounce to actually somewhere between $3,300. Okay, so a bit of bounce is good. Okay, but again, I do not recommend selling in the gold prices because even if the market can go up to $3,350, it is still very much part of a larger corrective pattern that suggests that at some point in time, 3,190 will be taken up. Okay, but be very careful trying to sell this. You want to be very circumspect because this is a very, very aggressive bull market, especially if the geopolitical situation deteriorates. It will actually encourage the price of gold to resume. Okay, silver is outperforming gold for some time now. We can see that the recovery in the silver prices is very corrective. In a higher time frame, which is the monthly time frame, the overall bias is still favoring lower silver prices, unless of course the market take up $44.21 per ounce. Okay, and that is a far cry from where it is right now. Right now, the market closed at $32 per ounce for silver. In the lower time frame, this is suggesting the market have finished its a very regular three-wave equality pullback. You can see it from a high of $34.86 to $28.34. This is unfolding in a three-wave corrective pattern with a very strong bounce. So this may actually cause prices of silver to actually continue to trade higher. So I will not be surprised in the coming days and weeks, silver may actually outperform gold prices. Okay, so keep an eye on silver because silver has been underperforming for quite some time. So we can see that the three-wave bounce finished at 100%, $28.44, and this will create the condition for the one more leg higher beyond $34.86. So I'm cautiously optimistic on the price of silver. Okay, so if you are also have the same opinion, perhaps one good area to consider if the prices of silver continue to slide in the event that it slides anywhere between, I'm sorry, this is $38, $30, anywhere between $30 to $31. I think that would be a great level to consider adding some buy positions for silver because this pullback from $33.67 appears to be very corrective in nature. Further losses into this bracket may actually create a condition for the returns of buying interest. Any question? Let me check if you guys have any question for me. I do not have Sing versus Ringgit on this platform, unfortunately. Kambi is asking, how do we tell if the pullback is due to profit taking or due to other reasons? You look at the pattern. The pattern is struggling. For example, when we look into the prices like this, okay, this is silver prices, okay? You can see that the rally has been very, very, has momentum behind it, whereas the pullback is a little bit of a struggle. So this pattern that we see, especially having three-way structures, is usually a sign that this is part of a profit taking rather than new sellers coming into the market. So again, there is no sure way of telling whether it's profit taking or the emergence of new players. Okay, but usually from the observation of the pattern that unfolds after a major run, okay, that will be the sign of profit taking. Okay, it will take you some time to actually recognize the pattern. Now, if there's no further question, I want to move on to oil. Now, over the weekend, we can find that on Saturday, earlier on, I did mention OPEC Plus has actually increased their quota for production. That is going to be negative for oil prices. So tomorrow morning in Asia, I do suspect that there will be the market opening with a gap down because this news only coming on Saturday when the markets were closed in New York. So we can see on a monthly basis, the overall pattern suggests the dominant trend in oil markets is still suggesting we're going to see lower prices. So will it decay all the way to $35? That will be catastrophic to a lot of oil producers. Maybe that is the intention of Saudi Arabia to increase production because they are the leading producer. And if they actually increase production, it will cause oil prices to actually decline. And that will cause a lot of marginal players to get out, to leave the market. Because like I said earlier on, as far as the US oil producers are concerned, especially for the fracking and the shale oil, they are they are not profitable if oil prices continue to stay below $65 per barrel for long. Okay, so they may decide to curtail production and they may over the longer period of time cause prices to stabilize. But if these prices continue to decay anywhere below $50 per barrel, it will be catastrophic for a lot of marginal oil producers. Okay, so again, US cost of producing oil is a lot higher than, let's say, Saudi Arabia. I'm not sure what is the cost of production for Saudi Arabia, but I suspect it's probably about $10 per barrel. So the Saudis can actually withstand this decline in prices a lot better than American producers. Okay, so tomorrow morning when the market opens, expect the market to go lower than $54.76 per barrel. So again, it will be very revealing how it will close by the end of Friday. So if Monday opens with a gap to the downside, I want to see a recovery to the upside by the end of trading this coming week. And that will be the reversal pattern that I'm looking at. Okay. So we cannot see from this chart there is any significant bias. Based on technical, without the news of the OPEC plus increasing production, this market may actually be a positive. Okay, if this is positive, that means to say that low here at $56.11 may hold, causing price to rally all the way to $67.75. However, this technical outlook has now been negated by the latest information as to the increase in production. So that will be that this bounce that we may going into the weekend may not happen. Okay. Just be aware, increase of production means lower prices. Any other questions that you have for me? We don't have them. We go into the last bit, which is Bitcoin. Now, Bitcoin has saw very steady gain in prices. On a month-over-month basis, we can see that the recovery in April has been quite dramatic, from 74,500 all the way to 97,000. So the prices has eased off a little bit over the weekend, about $2,000, but it's a small pullback in the bigger scheme of things. So whether Bitcoin prices can remain elevated remains to be seen. But so far, the technical outlook seems to be suggesting that we may see higher prices. Okay. The only consideration I will see is if the market cannot break above $100,000 per coin, okay, then there is a possibility that we may see a larger pullback. But until we see that, so far there is no sign that the market cannot break 100,000. Maybe it will break because if it does break 100,000, it will turn the entire bias to positive. Okay, so far we have a three-wave pullback already. You can see this very similar three-wave pullback, which will be very much evident in the lower time frame. This is the three-wave pullback. It hit 123% and then stabilized at 74,500 before the bounce. So near term, if the market cannot continue higher, especially above 102,000, it may actually slide back. The nearest area of support appears to be somewhere between 83,000 to 86,000. So the price do come back into this bracket of prices. This could be the last area in which the buyer interest may re-emerge, because it's also this bunch of prices that cause the price to break above this resistance right here. Okay, so I suspect if the market do pull back, it may be met with buying interest within this cluster of 83 to 86,000 per coin. Okay, near term, very, very corrective. Near term, in the 4 hours time frame, nearby support is about 91,600 to 92,900. So, but if the market do trade below this, then refer back to the daily time frame of 83 to 86,000. There's one more question which I will address. What about natural gas? Good question. Natural gas. Okay, as far as natural gas is concerned, the weekly time frame is very telling. You can see this very strong closing on the weekly basis, and it may or may not be affected by the increase in production in crude, but based on the closing in the natural gas prices at the end of the week at just under $3.80, it does lay the condition for higher prices. Purely technically speaking, I think the market may be gearing for higher prices in natural gas. So this is how the market reacted on Friday. Very, very strong closing. Okay, because he has finished the three-wave pullback, very, very clear in a daily time frame, three-wave pullback at 100%, followed by a rebound. Okay, so this may actually be the resumption of the bias to the upside. 4 hours is the same thing. Once the market take out $3.90, you'll be on the way up. Okay, so look out for further gains beyond $3.90. This level must be taken up on the lower time frame. All right, I think I've come to the end of my presentation. If there's anything else you want to ask me before we call it a day, do let me know now. XRP. XRP is not really moving a lot. In fact, it has been stuck within neutral gear. We have a bit of a bounce in Ripple, but it does not appear to have finished its pullback from the high of $3.40. This pullback would ideally, I would like to see $1.38. Okay, but so far, the Ripple prices has been stuck above $2. Okay, the lowest we have seen so far for the month of April is $1.61. Will it continue to slide further? Based on the rebound so far, this rebound has been very corrective in nature. So there's every risk that further decline is quite possible. So if we ever see a decline in Ripple down to $1.38, that will be to look out for buying interest. Okay, because I'm still looking for levels to go in and buy Ripple. I have yet to be successfully anchored a long position in Ripple. But if the price can come all the way here to $1.38, I am definitely very interested to establish long position and keep them. Okay, here you can see the market right now, near-term support is anywhere between $2 to $2.12. So far, the low here has been very well respected. You can see the low here is $2.03. Market go up, come back down, sit on $2.11, came back twice again, and then rebound. So again, there's very evident here in the near terms, in the 4 hours time frame, there is immediate support around $2.03 to $2.12. Okay, but if these levels cannot hold, prices close below $2.03, gun for $1.38 when you refer back to the daily time frame. Okay, anything else? All right, if there isn't, I'd like to call it a night, and I thank you all for your attendance, and I shall see you next Sunday. Bye-bye. Take care.